Now, it's no secret that at this point, a lot of investors as well as money managers now think that there's an elevated chance that we are going to see a recession sometime late this year or early next year. And because of this, along with other things, the stock market is reacting exactly how we would sort of expect it to. But in this video specifically, I'm going to share with you guys the true opportunity that a recession or just simply how a stock market crash can change everything for your portfolio and for you personally long term. I'm going to share with you some of the positions that I added to my long-term portfolio back in 2020 and 2021 when the stock market crashed like crazy, positions that I'm still holding today that honestly changed the trajectory of my investing career moving forward. Then later on, I'm going to share with you some positions that if they hit a certain buy level could also change everything for you if you're willing to take upon the opportunity. So if you're a long-term investor looking for some help on how to navigate a possible up-and-coming recession in the stock market, that is, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, I sort of mentioned that throughout my long-term portfolio, there were certain positions that I added in a large way, and this is during the last 2020 crash. Now, although I would kind of consider myself a buy every day long-term investor, meaning that I go through positions, whether they're expensive, whether they're cheap, I pretty much buy the highest quality positions, in my opinion, that is, on a daily basis. So some of my positions aren't necessarily as cheap as they used to be, and that's because I've drove the average cost per share price up by buying also on the way up. But to give you an idea, there's a few positions in this portfolio, like my 1,000 shares of Apple stock, which I bravely purchased back in 2020 and 2021 for around $118 per share. Now, even though it's hard to remember, and maybe for some of the newer investors watching this video that maybe haven't even been investing that long, you probably don't remember it because you probably weren't investing during this time frame. But in March 2020, the entire stock market was just going at a free fall. And Apple stock back in those days was very, very cheap. Apple stock at one point dropped to below $60 per share. And then, of course, quickly after rebounded up to $124 per share. So it wasn't even all that long to where buyers got an opportunity to grab shares of Apple, which is partially why my average cost per Apple isn't even as cheap as it probably could have been. But to give you an idea, there was a small period of time where the stock market was trading off. It was maybe just a few days, if I remember right. And I, back in the day, just started investing maybe a year or two before this. I was building up my Robinhood dividend portfolio, and I took it upon myself to buy a ton of shares of Apple at $100 per share, at $90 per share, and kept buying Apple stock basically all the way up, like I showed you guys a second ago, until I had 1,000 shares at an average cost of around $117 or $118 per share. Now, although I have to be completely transparent, back in March 2020, it's not like I really exactly knew what I was even doing. I just thought to myself that I'm a newer investor, relatively speaking. I have some cash to work with. The market is absolutely melting. And I think that Apple as a company, as a stock, is going to be around for a long, long time from now. So I went in heavily and made Apple stock my largest position across my portfolios, which obviously in the long term has played out quite well. Now, how well has this actually played out for me? Well, Apple stock as of right now is still trading at over $200 per share, which means that I'm up nearly $90,000 or $100,000 plus dividends that I've been paid every single quarter along the way on that single position. And that was because I took advantage of a buying opportunity that I saw during March 2020 when everyone was freaking out and when the world seemed like it was ending. Now, could I have bought Apple stock at an average cost of $118 per share? And could Apple have, of course, traded down from there for the next several years, making my investment absolutely horrible? That, of course, could have always happened too. But even for me being a relatively newer investor, I had enough hope that Apple stock was going to return to all-time highs, which it ended up doing so very, very shortly after. Now, throughout my long-term portfolio, there's many other positions that I was lucky enough to grab at much cheaper prices, which not only makes me up substantially as far as price return goes, but on top of that, there's positions in here that I have a very, very high starting yield on cost. Now, the way that yield on cost works is basically whatever a current stock or ETF is offering as far as a dividend yield. For example, SCHD, where it's currently trading, is offering around a 3.5% dividend yield. So if you buy a share of SCHD today at around $79 per share, that means you're going to earn around 3.5% per year in dividends. But the interesting thing is, when it comes to yield on cost, is that when SCHD dips in price, the yield on cost is going to go up substantially. For example, just a few months back, SCHD was offering, this same exact ETF was offering investors like myself that were taking advantages of the dips, it was offering us a 4% starting yield, which is 0.5% larger than investors are getting today. Not to mention back in 2020, if you were an investor that was willing to take a risk on SCHD, you can see right here that your yield on cost would be 7.16%, which means that SCHD, a dividend growth ETF that normally offers a relatively small yield and grows in price over time and also pays more and more in dividends over time, you would have had a starting yield of 7.16%, which I'm just going to go ahead and say it will probably make you rich off of cash flow, even if you have a relatively small amount invested into it. Now, this is exactly why I personally think buying into high quality assets, especially ETFs like SCHD, DGRO, and others, if you're able to get them when they're offering what I like to call an accidental high yield, that can completely change everything for you and could even potentially make it so that you can retire off dividend income earlier than you would have thought. Because let's just do some simple math here. If you would have bought a ton of SCHD or whatever the case might be back during a massive market crash like we saw in 2020, and let's say you're getting a starting yield of around 7% versus a current yield of around 3.5%, that means that technically you are getting paid double the cash flow that every other investor is getting if they would have bought a share of SCHD today. Now, we're all in different situations, we all have a different amount of expenses, etc. But still, with double the amount of cash flow, it can change everything, especially if you're a dividend investor looking to gather as much dividend income on average per month, per year, etc. Doubling the amount of cash flow because of a buy the dip opportunity, because of a market crash, could change everything for your long-term investing horizon. Now, this is exactly why I think taking advantage of market dips, market crashes, market corrections, whatever the case might be, could be very beneficial, again, if you're investing into high quality assets that at least historically have always recovered. But to be fair, just like we talked with Apple stock, just because I bought my shares and the stock ended up recovering, and not only recovered, but basically doubled in share price just after a few years, it's not of course always going to be the case. But again, if you buy into high quality assets and take that with a grain of salt, buy the dip opportunities, market crashes could be potentially life-changing situations for you and your investing career. And let me tell you, you only need a few of them to change everything. So while a ton of newer investors are super scared and freaked out seeing their portfolios dip and not knowing exactly what's going to happen next in the market, if we're going to see a market crash, if we're going to see things drop 10%, 20%, 30%, I just look at this whole situation and remember how important 2020 was for my specific portfolio, how massive some of my yield on costs are across my portfolio, and how some younger investors just getting started off can change everything for their portfolio long term if they just take advantage of specific opportunities. But now lastly, I want to hear from you guys down below. What is one stock or ETF that you're going to buy into if the market does crash even further from here? Drop some of the ticker symbols in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.